Hey, here's one of the most important decisions I've found facing real estate investors, and that is, should you keep your property LLC as a pass-through entity or make that S-Corp election? I get this question constantly from individual investors who've been told by their accountants that, hey, the S-Corp, that's a fabulous tool and it's going to save you thousands of dollars in self-employment taxes. Well, here's the thing. When it comes to rental properties, that advice will probably cost you money and create unnecessary complications currently and down the road. By the end of this video, you'll know exactly when an S-Corp election makes sense for your rental business and when it doesn't, and why the structure you choose can make the difference between keeping more of your rental income or basically handing it over to the IRS. All right, now listen, before we jump in, I want to tell you about an investor I worked with last month. Let's call her Sarah. Well, see, she'd been running this rental portfolio that she'd worked with her CPA on to set up through an S-Corp. Yeah, she'd been doing this for 3 years, and her CPA told her, this is going to save you money. And I just pull my hair out whenever I hear this. You know, where the CPA is coming up with this information that actually structuring a business through an S-Corp rental real estate is going to save someone money. When I analyzed her situation, what we discovered is that she was actually paying more in taxes, and she was losing out on valuable tax deductions that could have saved her on average probably $12,000 to $15,000 a year. And then we were just scratching the surface. And now this is exactly what I want you to understand, that entity taxation is critical for your wealth building strategy, especially if you're a real estate investor. So you want to make sure you stick around, because I'm going to show you how to avoid Sarah's mistake and structure your rentals the right way. All right? That was a long opening, so let's get started. Okay, so here's the basics. Let's start with the fundamentals. When you form a limited liability company for your rental property, the default tax status is going to be what we refer to as disregarded. Okay, that's if you're the sole owner. Now, if you have another person involved in that company, let's say it was you and your wife, then it would be treated as a partnership. Or if there's more than one owner, you know, you, your wife, and a couple other investors, again, that's partnership taxation. What this means is that all of the income and losses will pass directly onto your personal tax return. There's no separate business tax return except in the case of a partnership that needs to be filed. So here's what I'm telling you. Disregarded, no tax return. Partnership, you have to file a tax return. Now, if you want that LLC to not be treated as a disregarded entity or a partnership, you can elect out of that tax treatment, and you can treat it as an S corporation by filing an 8832 with a 2553 application with the Internal Revenue Service. Now that 8832, that's a change of accounting election. I can't tell you how many people that we run into here at Anderson on the tax side who have set up LLCs and elected to treat them as S corporations that have missed that filing. That is a critical filing that must be made as soon as you set your business up and you get your EIN. Now, I'm not going to go into that filing and how that works. I just want you to understand that in order to convert to the S-Corp, there are some steps that you have to go through. Now, here's the thing, okay? This is where most investors get confused. You see, the big selling point on S corporations is always avoiding self-employment taxes. I mean, you can watch video after video on YouTube where individuals will be telling you, when you set up an S-Corp and you take out money, you pay a reasonable salary to yourself. Let's say I made $80,000 in my company. I'll take a $40,000 salary and I'll take another $40,000 as a distribution. Now that $40,000 distribution, you don't have to pay employment taxes on. You only pay employment taxes on that $40,000 salary. So you're saving $6,000 in taxes. Now, that is an attractive benefit for somebody who is running an active business, to save on that 15.3% Social Security and Medicare taxes. So the S corporation allows you to split this income. So you think, that's great. But here's a critical point that most people miss. That is, rental income that is from real estate is generally not subject to self-employment taxes anyways. The only way your rental income or your income from real estate, take the word rental out, well actually it could be potentially, is going to be subject to self-employment taxes is if you're determined in the eyes of the IRS to be a dealer in real estate. Now, I have ample videos on my YouTube channel that you can check out about what it means to be a dealer in real estate and what are the negative tax ramifications that come from it. One of those being that the income you generate from your real estate activities, even the rental stuff, is considered active, subject to employment taxes. So that's what I'm getting at here. Generally speaking, the IRS is going to treat your rental income as passive and it won't be considered active. So you don't have to worry about this 15.3% tax that everyone talks about saving by using an S-Corp election. So when do S-Corporation elections backfire for your rentals? Well, let me walk you through some of these major problems that you're going to have. We'll call this one the reasonable compensation trap to make it simple. Let's say you elect S-Corporation status, and the IRS requires you to pay yourself a reasonable salary or compensation for the services that you're performing for that rental real estate LLC. So that means even if you're just a manager of your LLC of the property, so you're finding the tenants, you're bringing in contractors to fix stuff, you're handling the turns and the maintenance calls and things like that. For rental property management, right, typically it ranges from anywhere from 7 to 10%. But if you're doing that and you've elected an S corporation, you're going to put yourself in a position now where you have to pay yourself a salary. And so when you're paying yourself a salary, what you're doing is by putting yourself on payroll, you're taking income that would have not been subject to employment taxes, that would have been considered passive, and you're making it active. So that's a big problem right there. Now, the other problem you have is the loss of what we call the QBI deduction benefits, okay? Qualified business income. Now, here's a big one that most advisors miss, and I have other videos on this topic as well. You see, with the qualified business income deduction under Section 199A, it allows you to deduct up to 20% of your rental business income. That is, if you have rental property and you're generating $100,000 a year from your rental income, you could write off or not account for 20% of it. I mean, 20%, 20K right off the top, non-taxable. But you see, with an S-Corp election, you're converting part of your business profits to salary, which means there's less income that qualifies for that 20% deduction. And that actually hurts you. So I'll give you an example of that. Let's say your rental generates $100,000 in profit. Now, if it was an LLC, then you would receive, like the previous example I stated, a $20,000 QBI deduction. That means $20,000 escapes taxation down to you. Now, instead, if you went with the S corporation and you set it up and your CPA told you have to pay a reasonable salary, this is where you're going to be cutting yourself, your benefits. Because if you set your reasonable salary, let's say at 50K, and now your QBI deduction is going to be reduced based upon the 50K distribution you're receiving, so you just dropped it down to $10,000. That means rather than escaping taxation on 20K in income from your rental real estate activities, you're only escaping taxation on $10,000. That's a 10K deduction you gave away by making an S-Corp election. Now, are S corporations more administratively complex? Absolutely they are, because you have to put yourself on payroll. So that means the W-2s and all that stuff that goes with that makes your business or the cost of just operating your rental activity go up considerably. So when does this make sense? You're probably wondering, because if you made it this far, you're thinking, gosh, what idiot would ever make an S election? Well, they're not always bad, and they do make sense in specific situations, like I talked about earlier when I dropped that hint about being a dealer. So if you're flipping real estate or you're a wholesaler, then an S corporation might make sense for you in your business because that type of income is considered active income. And if you went strictly with the LLC pass-through, say disregarded to run all that activity through, then you're going to fall back into that problem where if you make $100,000, the entire $100,000 is going to be subject to that 15.3% employment taxes, the Social Security and the Medicare. So you're going to find yourself paying more in taxes by running those types of activities through a pass-through LLC that's treated as a partnership or a disregarded entity. Another situation where an S corporation would make sense is if you're setting up a property management company. With the property management company, here you're performing an active service for your rentals. So if you've seen me talk about this before, what we do is we create some limited liability companies like this, and then we have a management corporation up here. And this management corporation is managing your LLCs that own each of your properties. And this is in exchange for a fee. So let's assume that we're paying this corporation. It generates $40,000 because you have a large portfolio. Anyways, it's paid into this corporation. Now, if this corporation does not expense out all of those funds, then it's going to pay you a salary. Now, that salary that it's paying out to you is considered active income and will be subject to employment taxes. So this is where the savings comes in, because with this type of structure, you're able to reduce your salary down to reasonable. Let's say we had $20,000 left over after expenses. You'd pay yourself a $10,000 salary, and then you would take a $10,000 distribution out of that. So this is where we're saving on taxes. That's $1,500 tax savings by using this type of structure. Now, another point I would like you to consider here too is that if you have mixed business activities, let's assume that this management company here handles both rental activities and it's also a management, and maybe it's running some other business such as a construction or renovation company. First off, if you're doing that, you would never want to do it in the way I described here, running all these activities through one business entity. So if you're in real estate, and let's say you're in construction, renovation, and you're doing property management, then the way you would want this to look from an asset protection standpoint is this is your main S-Corp right here. And I would create another entity over here. I'd do an LLC that's disregarded down to this S-Corp. And I would have my rentals down here, and then this LLC, we'll just call this the PM. It's going to manage all these. This S-Corp is where I'm running my contracting business through. Okay, this is where I'm running the contracting business. Why am I doing it in this manner? Well, predominantly what I want to make sure of is that if something happens with the property management side, right? So let's say we have an injury down here. This actually occurred, and I've talked about it in one of my previous videos. Somebody came out to our tenant's property. They fell out of their wheelchair. They stepped on a nail. I don't know how that happens when you fall out of a wheelchair that you actually step on a nail, because supposedly they couldn't walk to begin with. But suffice to say, they don't only sued the LLC, they also sued the property management entity, because they're saying that the property manager was negligent in not ensuring that the property was adequately maintained and in a safe manner. So in that case, I want them coming after my LLC, but not my S-Corporation contracting business, because that could cause a serious problem. Now, the income side of this is that if this company generated $40K in profits, you see, this would be a disregarded entity, and all those profits would flow down here to the S-Corp, and then that's where I would take my salary out of. So you can structure it in some different ways with entity stacking that makes sense if you've got a mixed business use structure going on there. And so from a pass-through S-Corporation standpoint, you know, the S-Corporation is going to be very limited. And so you don't want to complicate your rental income with making an S-election on your holding structure. Basically, what you should be doing for your rent or real estate is avoiding the S-election and only using it in the limited circumstances that I described. So what do I suggest then that you do? Well, you've seen this probably a million times if you've been watching my channel over the past 17 years. What I'm going to recommend is you create separate LLCs for each of your properties, right? So we create all these LLCs here, and all of these limited liability companies are going to be disregarded. All right, so they don't have to file tax returns. Now, I'm going to put a holding company down here in Wyoming. So this is going to be your Wyoming holding company. And it's also an LLC. All right, so these LLCs will all be owned by your Wyoming holding company. And then you're down there, you and your spouse. And then this one will be a partnership for federal tax purposes. So again, we're using the flow-through treatment, the disregarded status of these LLCs to ensure that all of the rental income generated from here will flow right down here onto our personal tax return, and it maintains its passive status. Okay, now there's ways to change that as well by showing that you're using the short-term rental rule, a loophole, or maybe you're a real estate professional. But again, that's beyond the scope of this video. I just want you to understand that that S-Corporation can be problematic. And what I didn't even touch on, which is important to note as well, is that if you look at the structure right now, let's assume that you wanted to refi this property, and you went to your lender and you said, I want to refi this property on Orchard Street. They're going to tell you if it's a single family home or a residential property, you need to take it out of the LLC in order to do the refi, unless you find a lender, of course, that will do it directly in the LLC. So you go to your local attorney or your title company and you have them deed this property into your own name out of that LLC. Guess what? That's fine. You could do it. Non-taxable event. IRS could care less. Now, you flip the script here. And if that LLC that owned that property here was treated as an S corporation and you kick that property out to yourself to do a refi, and listen to these numbers here. Let's say your tax basis, what you paid for it and what you've invested into this property is sitting at 150 and it's gone up in value. And now the value of that property is, let's say, 300K. So when you deed that property out of that S corporation, that is a deemed sale. Yep, just transfer yourself. The IRS looks at that. Hey, you just sold the property, Clint. So you have $150,000 in income. We expect you to pay the taxes on that. And you're looking around thinking, I didn't sell it. I didn't make any income from this property. I'm just refinancing it and I want to put it back. That's the problem with S corporations as well. It doesn't protect you in this manner when you're going to be moving properties around within your structures. And that's something that comes up a lot as real estate investors. As we refi our properties, we will be moving them in and out. Maybe you're looking at some other to diversify or enhance your asset protection, so you want to move them to different structures. See, S corporations really lock things down. So here's what I want you to keep in mind, the decision framework for rental property investors, all right? Stick with pass-through. If your primary income is from rental properties, all right, meaning you're not flipping, you're not performing significant management services, you're just acting like a landlord, you want to maximize your QBI deduction, and you want to keep a simple tax compliance, and you're not focused on running an active business out of this structure. Again, going back to the flipping and wholesaling. That's why if you are going down that road, you should consider the S election. All right, the S election is for those people who are going to actively flip real estate, all right? Or you're going to run a big property management, or you're running that mixed use stuff. Now, you heard me bring up real estate professional status, and you think, well, if I'm going to be a real estate professional, Clint, shouldn't I be in an S corporation? Not at all. Real estate professionals, stay in the pass-through status lane, all right? That's where you want to keep that, because that will create better tax deductions for you, all right? So here's the bottom line, all right? Don't let the tail wag the dog. And that's what I mean is that the entity structure should support your overall wealth building strategy, not complicate it unnecessarily or put you back on a tax side. Many times when it comes to asset protection planning, and we talk about this structure a lot during our events, we say, hey, there's a three-legged stool here we're working with. We're working with asset protection, tax planning, and business planning. And you need to focus on all three of those and putting together a serious structure to help support your long-term growth with your investing. So if you're serious about building a rental portfolio that's both tax efficient and lawsuit proof, you need a comprehensive asset protection plan that's tailored to your specific situation. You know, these cookie cutter solutions that I see out there on the internet all the time typically do not work, especially when your financial future is on the line. So here at Anderson, we've helped thousands of real estate investors structure their holdings the right way, and we would love to help you. So why don't you do this? If this interests you and you want to get your plan protected, click on the link in the show notes below and set up a free strategy session with one of my advisors. What we'll do during that strategy session is we'll analyze your existing situation, look at your properties, how much income you're generating from them. We'll show you an asset protection structure that will not only protect your assets, but also make you invisible with your investing, and then show you how you can tap into the tax code by using these entities to make them more tax efficient for you. Remember, the goal here isn't just about paying less in taxes, it's also about building a sustainable wealth plan that is protecting what you've already built today and into the future. And sometimes that means keeping things simple. Sometimes that means we got to get a little more complex. But at Anderson, we can help you do that. So guys, I'd like to end with this. Hey, if this video has helped you demystify the LLCs versus the S corporation question, Hit the like button. If you're not yet a subscriber, hey, subscribe to the channel. And if you know any other real estate investors out there that have been wondering about this S corporation versus LLC conundrum, send them a link to this video. Make sure they watch that before they go in to talk to their CPA if they're not using Anderson. At the same time, ask them, hey, why don't you use that Anderson group? They know what they're doing. They can help you get structured the right way. Take care.